Welcome back. Thank you for staying with us and moving on with the program. As tensions continue to escalate in the Middle East, with Iran at the center of a widening conflict, global economies are watching closely. The region plays a critical role in global energy supply and trade routes, and any instability there has the potential to send shockwaves through oil prices, shipping costs, and inflation. While the conflict may seem geographically distant, its economic impact could be felt much closer to home through higher fuel prices. We speak to economist Sanele Sibia to help us unpack how the Iran war could affect African economies, specifically the kingdom. And he joins me now in the studio. Mrs. Sibia, good to see you. Thank you very much for your time. Maybe it's not really safe to say, but I think the right thing to say is economically it's time to strap up. Ne? The Middle East accounts for roughly a third of global oil supply, and 20% of that goes via the Strait of Hormuz. With tensions rising, they rather raise fears of disruption in supply. How serious is the risk to global energy stability right now?
Thank you, Notzile. Good afternoon to you, and thank you for having me. So, yes, like you rightly pointed out, so this tension, geographically, it seems it's miles away, but when you look at it in terms of the global interconnectedness, it's one would say it's very close to home. Just that we are not fighting there in the front lines. But in terms of the economic impacts, now those are going to ripple through the entire globe. Because if you look at the amount of global oil output that comes from the Gulf region, we have about 20%, 1/5 of the entire global output, oil output, comes from the Gulf region, from those Gulf countries. And then in terms of the transit of that oil and that natural gas from the Gulf region into the rest of the world, around 20% of it, again, has to flow through the Strait of Hormuz, right? And that's just a choke point there between, I think it's Iran on the northern side, and I'm not sure if it's Oman or any other country on the other side, right? So that's what the Iranians are now blocking, because it's right up their door. But when you look at its impact in terms of global disruptions, now that is where most of the disruptions are coming from right now in terms of the oil prices. So evidently we are going to start feeling that impact in terms of pump prices. Just probably but most of it depends on how long this crisis is going to go on for, because if it goes on for, say, a week, most likely it's going to be one of those very transient type of impacts. You're not even going to see it in terms of the movements here at home. But if it goes into the weeks, as President Trump keeps on saying, in terms of he's going to do whatever it takes to meet those objectives, then if it stretches, then that's when we're going to start feeling it. In terms of the price of oil, in terms of the price of gas, in terms of overall supply chains, and it is going to be a supply disruption if the Iranians can continue to hold fort and keep that strait blocked. It's going to be a supply disruption, because we then expect countries like China to start looking for new sources of energy, and then in Europe, already the numbers are running carnage there in Europe. If you look at what's happening in terms of LNG, that's liquid gas that the Europeans use to heat their homes, the numbers are off the chart. They've gained up approximately 60% in just 2 days. And then if you look in terms of the price of Brent crude oil, we've actually passed the 85 mark just briefly today. We passed it, and then now that should tell you the amount of uncertainty that there is in the market. So currently we're trading at 83.15, but earlier on in the day we did reach highs of 88.42. Right. So if this crisis continues, we should expect that by next week, if we are not seeing any positives coming out of the White House in terms of how they're going to stabilize the fuel stocks and the fuel supply, then you're going to see that jumping into the 90 zone, and if it continues another week, most likely we'll hit the 100 and cross the 100 mark. And now those are levels we last saw during the COVID pandemic. So right now, this is coming in at a time when the entire globe is trying to readjust and rebuild from COVID, and then now we are getting into another supply side disruption, which will inadvertently be a supply shock because, trying to figure out how you're going to get your oil in a very short space of time may not be as tenable as possible, as may not be as easy as one would think. Yeah.
Trump said whatever it takes. In other media platforms, he implied that this could go on for at least 4 to 5 weeks. We don't know how long it could go for, but if prolonged, what does it mean then for global inflation?
Global inflation is one of the things we are looking for right now. We are looking at right now because if you're seeing the price of Brent crude oil hitting that $88 per barrel mark today, and sitting at 83. Now that's going to creep straight into the price of commodities that you are buying, right? So inflation fears are coming back across, global central banks, and that in itself is largely contingent on how long this war takes, right? And also remember that if the effects of this war creep into markets and the inflation story they're in, then that usually takes a bit of some time to really just adjust and go back to normal. We've just seen that the Feds in the US, just cut their interest rates quite slightly, but we were expecting that was going to be a continuous trajectory. But right now, with this uncertainty, so it's sending shocks to markets, and markets are somehow thinking around those issues to say, how are we going to now fix that? And if you look into Europe, the story is even more pronounced there in terms of the gas imports, because what has happened is Qatar has actually halted its production of that liquefied nitrogen gas. So that means that gas is not going out into the European markets. That's why we're seeing, the spike in energy prices in Europe now really shifting up. And now, again, we are talking of a consumer in Europe who's already battling high prices, and energy was one of those key factors there. So now that then also goes to show that, in as much as we're seeing inflation fears, it also might mean that we are going to likely see a bit of a subdued demand coming through from the Europeans if this is sustained.
And for the consumer in Eswatini, what are some of the immediate economic consequences that they should be preparing for?
So the way we'd get to see the impacts in Eswatini is it's twofold. The first fold is the direct fuel price. That's what we're going to see. But at least that for now we are not likely going to see it at least until say April or May, if indeed this conflict persists. And then the other one that we are going to feel as well is the imported inflation channel, where since we are a net importer as a country, we are going to be importing commodities that are now priced, taking into consideration the higher price of oil, and now that is going to fit into our inflation story in Eswatini, and that means the consumer is going to have to do a bit more, so to spend a bit more than they're spending right now. And then there's also the exchange rate channel, where right now we're seeing that with this conflict, the dollar is strengthening again. We are back above that 16 mark against the dollar. And now what that means is for every commodity that we are importing into Eswatini today, as of now, you are paying, I think, 3 or 4 cents more per dollar than you did yesterday, right? And then think of it, if this persists into tomorrow and the following day and all of those in the following weeks, then we are going to be importing inflation through the weaker exchange rate now, because we need more malanya, you need to pay for your imports. So that's what consumers are going to see. So yeah, it is going to creep into our inflation figures in Eswatini, and that means the consumer might have to raise a bit more, but not in the very near term. So this is something we'd expect to have, serious consequences if it drags on at least for a month.
You've just touched on the dollar strengthening due to the geopolitical instability. How does that complicate, the situation for African economies that especially import fuel and commodities that are priced in dollars?
Yeah, that's precisely the issue around imported inflation, because what it means now is you need more of your currency to buy
Yeah.
whatever dollar-denominated commodity you are buying into the African countries. And what it means is now when the retailer or the wholesaler is now selling to you as a person, they're going to charge more because they spent more emalangeni just for that one commodity, even though the price of it may not have changed. But in terms of the malangeni required now to get that commodity, it makes it a bit more expensive. So what this then does is it creates a situation that is twofold for Africa. We know Africa is a resource-rich country. It's a resource-rich continent, so that means, for those that are trading in gold, your silver, and all of those other precious minerals, the price of those is also doing very, very well in markets, just being offset a bit by the dollar. So what that means right now is we do have an option to continue, get benefiting from the resource richness in Africa. Because we are selling these, we are exporting these resources in dollars, so then that should somehow show up, our balance sheets. But then at the same time, in terms of the cost of importing, that now, pushes the imports out of the roof, and it tends to weaken Africa's trade balance position because we then tend to run more of a deficit type. When your imports outpace your exports, the position you end up on is not that one of a secured economy, in as much as we do have a bit of security. So as Africa, we kind of need to ensure that we diversify so that we can, improve regional value chains, intra-Africa value chains, so that we are insulated against such movements. And in terms of even our imports, in terms of this natural gas, and in terms of the Brent crude in itself, we do know that countries like Nigeria, quite a number of countries in Africa, do have that one, in countries. So I think as we continue looking at avenues of trading through the AfCFTA, then most likely we would then start looking at how we then import internally within Africa, so that we are somehow cushioned against these global disruptions. But when you're looking in terms of the price of oil, most of it is dollar denominated, so exchange rate risks will always be there, even if we are looking at domestic insular into Africa.
Thank you very much, Mr. Spear, for that one. That was in-house economist Anele Spear breaking down the economic impacts of the ongoing conflict in the Middle East. While we still have him, we're going to discuss markets immediately after this.